Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Here is what we're watching this hour. First up, we'll have full market coverage ahead after a choppy week for stocks. Plus, we'll hone in on the state of the labor market after October saw 150,000 layoffs announced. And we'll sit down with DraftKings CEO Jason Robins to discuss the state of sports betting. First up, let's take a look at the major averages because we do have the selling pressure continuing this morning. Right now, the Dow is down 130 points or so. That's about 0.25%. The S&P 500 down about 2/3. And then you have the NASDAQ down about 1.2%. And this is really a continuation of what we've been seeing all week, where we've been seeing selling, but it is especially acute when it comes to large cap technology. So the NASDAQ composite now down by 4% on the week. We had the selling earlier in the week, a little bit of relief, and then just a resumption of that selling. And this does seem to be a pause in the upward momentum in large cap tech stocks amid questions about valuations. Most of the people we've talked to here on Yahoo Finance have pushed back against the idea that there is a bubble in valuations. However, we are definitely seeing something pushing down these stocks. So let's dig into the NASDAQ 100 here and look at some specific movers. We got NVIDIA down 3% today. Couple of things going on here. First of all, Jensen Huang, the CEO of the company, said in Asia that they're not currently shipping any chips into China, specifically the Blackwell chips. At the same time, The Information, which is a tech publication, is reporting that the administration might block them from shipping any chips into China, including scaled down chips. So all of that perhaps weighing on the shares to some extent. Remember, NVIDIA reports its earnings on November 19th. We got Broadcom on this list down by 2%, Google down about 2.25%. In other words, you see some red on the screen here from some of the recent high flyers. Tesla, by the way, down 3.5% after its shareholders approved Elon Musk's 10-year $1 trillion potential pay package. So those shares trading a little bit lower after we saw all of that. And then, as you know, we like to look at the sectors here. So we've got energy for the second day in a row that's rising, consumer staples as well. Tech and communication services, again, are lagging here. We also just got some economic data coming out. Michigan sentiment coming in weaker than expected at 50.3. The estimate had called for 53. This is the lowest reading since June 2022, so about a 3-year low. The current economic conditions index fell to a record low as well, 52.3 last month. So all of this indicating that consumer sentiment right now is pretty low. Let's talk more about this and what could be contributing to it. Remember, typically on the first Friday of the month, we'd be covering the jobs report. But since the government remains closed, the Bureau of Labor Statistics didn't release that report. We're left to parse over private data, from ADP's announcement that private sector payrolls rose by 42,000 last month, to numbers from Challenger Gray and Christmas that showed a more than doubling in job cuts among large firms. Here to help us try to make sense of all of this, Betsey Stevenson, professor of public policy and economics at the University of Michigan. And Betsey, of course, previously served as chief economist at the Labor Department and was a member of the Council of Economic Advisors under President Obama. Betsey, great to have your perspective here this morning because we've got a lot of conflicting jobs data. So how do we know what's going on, and what's your assessment of what's going on in the labor market?
Well, I mean, the first thing is we can't pretend that we're not missing data, because the federal government data that we're missing is a really important piece of this. It's great that we have the ADP data. Keep in mind, ADP is a huge business. They have almost 500,000 companies that rely on them for payroll processing, which is why they can cover give us information on what's going on in the labor market. About 26 million Americans get their paycheck processed through ADP, and their data tends to be correlated but not perfectly predictive of what we would be getting from the BLS. And what we're seeing from ADP is we have ongoing job growth, but it is much, much slower than what we had before. And then we're putting this in, together with data that says that we're seeing a pickup in some amount of layoffs. I don't know how much stock I would put on that just yet. I think what we're seeing in the labor market is a labor market where hiring has dramatically slowed. So if you have a job, great. And I don't think that there's a ton of risk that you're going to lose it. But if you do lose it, you're kind of in more trouble than you would have been, say, a year or two ago, because we're not seeing a lot of hiring. And so it's going to be harder to find that job. For sure, what we've seen in the last 6 months is a decline in the dynamism of the economy, meaning there's a slowdown in businesses forming, businesses hiring people, and all of that leads to a slowdown in the labor market.
And we do have, in terms of data, we have the weekly unemployment benefits coming from the states, right? And that, again, doesn't show us a lot in terms of clarity in what's going on. And in any case, that's more on the losses side of the ledger, not the hiring side of the ledger that you're talking about. But, you know, the stuff that we do have like that, what is that also telling you about sort of labor market demand out there?
Well, you know, we always see that some people lose their jobs. And it can be very hard in those weekly claims without a longer time series to really see, are we really seeing a pickup in layoffs? As I said, I think there is some suggestive evidence that we're seeing a little bit of a pickup in layoffs, but not one that I would necessarily say is makes it time for us to panic. I think the bigger problem for American consumers, as they're taking a look at what's happening around them, the labor market's slowing down, so it's harder for them to find a new job, maybe to get that raise that they want, to make a transition. They're at a slightly increased risk of losing their job. And they're going to the grocery store, they're shopping for, maybe getting that early start on shopping for Christmas, and they're seeing higher prices. And you put that all together and nobody feels good about that. You know, rising inflation and a slowing labor market is a recipe for a really uncomfortable economy.
Betsey, we've talked about before also the split in the economy, and looking into the University of Michigan sentiment numbers that I just mentioned, where the numbers are not good, right? People don't feel good, to your point. One interesting thing, according to the release, consumers with the largest tercile of stock holdings posted an 11% increase in sentiment as we've seen markets go up. And as we see, you know, can those folks keep the economy afloat? And if so, for how long? And how long before their sentiment starts to roll over?
You know, I get asked this question a lot. Should we be worried about the fact that there is a small number of people who are doing incredibly well, maybe because they hold a lot of stock, so they're big capital holders and the stock market's doing great, maybe because they're just, you know, very high earners and the top of the labor market's doing well? I think that there are problems when you have that K-shaped economy and there's a small group of people doing really well. I don't think the problem is macroeconomic volatility, like a risk of a recession. I think the problem is social cohesion. I think the problem is the potential for social and political unrest. Nobody wants to live in an economy where there's a tiny number of elites and everybody else can, you know, barely hang on to what they have. That's not an economy that people want to be in. And I think we should be much more worried about what that means for the state of our nation than the risk of a recession.
Betsey, I also want to ask you about the shutdown. Kevin Hassett, the president's economic advisor, was on another network this morning saying that economic growth, GDP in the last quarter, could be half of what was estimated as a result of the shutdown. Do you think that's too dramatic to say, or do you think it will have that kind of a large effect?
I think that's too dramatic to say. You know, we can go back to past estimates and we can see what kind of negative effect there is. Some of the negative effect is a little bit mechanical. In other words, it'll get made up in the next quarter, because if we open the government back up and we pay those government workers, then we're going to get that money, you know, back into the economy. You know, I think the bigger issue with a shutdown is the stuff that's actually not going to be measured in GDP. Right? We've seen the airlines are working overtime to try to figure out how to cancel flights in a way that causes the least disruptions to their passengers, to their business. We see there's a lot of people out there, whether they're government workers who had to do this before the shutdown, or whether they're private sector workers scrambling right now, trying to figure out how to optimize in an economy where the government shut down. That is a waste of people's time and attention. And I'd really like them to get this government back, opened. But it is worth saying they're fighting over something very important, which is, what should health insurance cost people when they can't get it through their employer and they're buying it on the exchange? That seems to be a really big issue for people's pocketbooks.
Betsey, great to see you. Thanks a lot for your time.
Great to talk with you.
Thanks. Well, as we were just discussing, over 800 flights across the U.S. have been canceled today. That's according to FlightAware, as the Federal Aviation Administration begins cutting flight capacity due to the government shutdown. Yahoo Finance Washington correspondent Ben Werschel has been tracking all of this for us. So, Ben, what's the latest about these flight disruptions? What do we know?
Yeah, so what we know is that this deadline to cut air traffic capacity by 4% came into effect at 6 a.m. this morning. This was the FAA's order. As you mentioned in the intro there, airlines across the board kind of preemptively canceled a lot of flights, delayed a lot more because of this coming in. So the first cut is today. This will ratchet up to 10% next week if this shutdown continues. But this is a real significant increase in the air traffic disruptions that we're seeing in this shutdown. It's worth noting that the threat of this was a major factor in ending the last shutdown at 35 days. Obviously, we're beyond that now, and we're at 38 days. So we're sort of sifting through what all these widespread effects here are going to be here at the airlines, which stretches all the way from Alaska to Florida and everywhere in between. Also in focus today on the economic front are SNAP benefits. A Rhode Island federal judge ordered the Trump administration to pay SNAP benefits in full. These are the food benefits that 1 in 8 Americans rely on. The Department of Justice immediately appealed that. There hasn't been a sort of significant way in there, but that could be a little bit of relief on the food side front, which is a bit another huge pain point here for folks around the country. Either way, on the SNAP benefit, it will take days to pay out because of the complexity here. So the economic pain is set to go throughout the weekend as there's a lot of gridlock on Capitol Hill.
And any signs of the gridlock ending, Ben?
Not a lot at the moment. I mean, we started this week with even Senate Majority Leader John Thune talking about optimism towards a benefit, towards some sort of resolution here. We're set to end the week without being any more closer. The Senate's going to come into session at 12 noon on there, and there's going to be another vote here. It's going to be a slightly different vote, extending keeping the government open for slightly longer, perhaps into January, offering full year funding on some specific programs. But the widespread expectation here is that it will again fail. It's failed 14 times so far. This would be number 15. Democrats remain really resolute that they will not vote to reopen the government until the healthcare issue is addressed. That's their focus. And I think the elections this week really kind of solidified their resolve there. I will say that there are bipartisan talks going on. Those have been going on for days. There's another one on the docket for today, and those could continue through the weekend. This is moderate Democrats trying to find a path out here. So that could bear fruit, but it's definitely kind of not getting closer in the last couple of days for certain.
Ben, thank you so much. Appreciate it.
Everything.
Coming up, DraftKings cutting its full-year outlook after missing third-quarter expectations. The shares are now higher, however, and CEO Jason Robins is going to be joining me next to discuss. You're watching Market Catalysts. DraftKings is reversing earlier losses after missing third-quarter earnings estimates and cutting its full-year revenue forecast. Joining me now, Jason Robins, DraftKings co-founder and CEO. Jason, it's great to see you. Thanks for joining us.
Thanks for having me.
So, and I guess you're sitting a little prettier now that the stock is trading a bit higher, but there was a lot to sort of dig into in these results that was not necessarily positive, namely the miss and the fact that you guys cut your forecast. Can you just give us some sort of high-level color around the decision behind that forecast cut and what the reasons are for it?
Well, you're right. We had it was a lot to digest in this earnings. We had a lot. So, there's some things that were good, some things that were less positive. I think overall, good to see that the reaction has been positive. Really, it was sport outcomes, and so we had to cut for that reason. But hopefully, we'll see some luck turnaround in the end of the year. We're already after a really strong start in terms of volume, so we'll have to see if the sport outcomes hold up. And also really excited about our announcement that we will be entering sports predictions. That's something that's been on a lot of people's minds for quite some time. And also thrilled to announce the big deals that we did with ESPN and NBC Universal we talked about. So a lot of great stuff going on right now, but certainly, disappointment that we had to cut the guy. But sport outcomes go sometimes in the customer's way, and that's not necessarily the worst thing in the world. It's early in the season, and last year something similar happened, and we ended up finishing strong in the playoffs and Super Bowl. So it can kind of swing either way. In Q2, for example, we had good outcomes and inflected on profit. We generated over $300 million of adjusted EBITDA in Q2. So it can kind of swing either way. That's the nature of the business, and this time customers won, but. You got to play for the long term.
Well, Jason, you tend to emphasize how data-driven you guys are. How do you get better at predicting outcomes with the data that you have, so that you can smooth it out a little bit?
Well, I don't think it's about predicting outcomes, really, because I think the lines are right. It's just what happens is people who bet typically want to bet on the favorites. They want to bet on the overs, on the point totals. So even if we're setting the lines correctly, if the lines are set at a certain level and all the action's coming on one side, sometimes the other side's going to hit and customers are going to win. The only really way to smooth it out is to get balanced lines, and the way that you can do that is by hedging or moving things around. But if you do that, you're trading off long-term value because you're giving up margin elsewhere in the ecosystem by hedging. And so if you're playing to maximize your long-term and maximize your EV, you kind of have to deal with a little bit of that outcome volatility, and it's just the nature of the way people bet. So no matter where we set the lines, to a certain extent, people are going to bet on the favorites on the money lines, and even if you make it much worse, then you may get less betting there, but it's still probably going to be skewed in that direction.
Jason, when you look at the forecast cut, how much of it was because of the outcomes and how much of it is because of the investment that you guys are making in the prediction market product?
Most of it was outcomes. There was some, though, that came from the predictions investment. We wanted to make sure we had enough in there so that if we're able to launch the product in Q4, there's going to be product and tech costs, of course, but then I also want to make sure we had a little bit of extra marketing cost in case we decided if we launched product in Q4, the data looked good, we wanted to ramp marketing up a little bit. I don't know that will happen. I'm not even sure if we'll get the product out before the end of the year, but wanted to make sure that we had some cushion to do that, and then the rest of it was sport outcomes.
Okay, so when are you comfortable saying that you'll get that product out? And I know you've said you're going to roll it out in states where you don't currently have the sports book offering. So what's the strategy there, and how are you going to be competitive against some of the upstarts that are already on the market?
Well, I think we can compete with anybody. We've shown that over the years. We've faced numerous waves of competition from, at times, very well-funded, very, strong technology-backed operators, and we've been able to do very well. We've gained share, and we've consistently grown our revenues, no matter who we've had to compete against. So I feel very good about taking on competition. That's never been a concern for us. Obviously, we take our competition very seriously. We respect them, but in terms of our own ability to compete and win, we feel like we have a great track record that speaks for itself.
And just a little more color on the timeline of when customers can expect that product, that DraftKings predictions product in their states, maybe?
We don't have a firm date yet. We're hoping to get it out in Q4, but what we've said we feel we can commit to is it'll be in the next few months. So definitely thinking we'll have it out before NFL season's over, but will we get it out before the end of the year or not? That's something we're shooting for, but we don't have a firm date for launching yet.
Jason, I'm curious about regulation of these prediction markets, because there have been a lot of questions about whether state regulators were going to come down on them, seeing them as sort of a way to get around sports betting regulations and tax revenue going to these states. What have your discussions with regulators been like over the prediction markets, and how do you expect all that to play out?
Well, certainly we've had a number of discussions. We have very transparent and open relationships with all of our regulators, and obviously have a great deal of respect for them and want to make sure that we are letting them know what we're thinking, getting their perspectives along the way. Obviously there have been quite a few that have both publicly and some cases privately expressed that they don't like it and have concerns with it, and we're going to be very we're going to consider those things in terms of where we decide we're going to operate. I think the nice thing is that also aligns with where I think the financial opportunity is, because we feel like, at least at this stage, the prediction products are very bare bones and are not able to be competitive in states that have legal online sports betting. So we're going to focus on the other states for now, and we'll see where things go over time. There's certainly court cases and other things that are going to play out that'll give more clarity.
And Jason, I got to ask you about the ESPN partnership as well, which was one of the positive things on the positive side of the ledger in the quarter. Can you give me any sort of numbers around that, when you expect that and how you expect that to start to contribute to DraftKings?
Well, obviously there's a transition there, so it's not like we can just start the next day, but we are diligently working to try to get this thing going as soon as possible. The teams are very excited, and the good news is that there's been a lot of work that's already been done, both by ESPN and by us, in terms of our marketing approach. So we're not starting from scratch here. There's already a playbook to follow. So still a lot of work to get things up and running and make that happen, but I feel like we're going to move at a pretty quick pace, and it's another one where I'm hoping we get that going before the end of the year.
Jason, thank you so much for your time this morning. Appreciate it.
Thank you. Thanks for having me.
We are nearing a big day here at Yahoo Finance. It's our annual Invest event on November 13th, starting at 8 a.m. Eastern. We got a special full day of live global coverage of the key themes driving the market. We're talking about AI, crypto, much more. We'll be talking about the future of pharma as well with Pfizer CEO Albert Bourla. Eric Trump will be stopping by to explain his all-in stance on crypto. And former Fed official Lael Brainard will share her latest thinking on the outlook for interest rates. You don't want to miss all of this. Yahoo Finance Invest, it's live all day on November 13th.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're taking a closer look at Penn Entertainment, Sweetgreen, and Expedia. First up, we're taking a look at shares of Penn Entertainment. That stock got an analyst who said that he sees Penn Entertainment and ESPN's decision to terminate their U.S. sports betting contract as a buying opportunity. That stock moving ever so slightly higher after Stifel upgraded the stock to buy from hold. Penn now plans to focus on its iCasino-led business. The analyst thinks that growth within that segment could be accelerated by reallocated financial and operational resources. That stock now has 10 buy ratings, 11 holds, and 0 sells on the street. Next up, we're taking a closer look at shares of Sweetgreen. The company missed Wall Street's expectations in its latest quarterly results. It also cut its full-year outlook, and that led to price target cuts on the stock across multiple firms. Barclays cut its price target to $5, RBC to $7, Oppenheimer to $10, and Piper Sandler to $9 per share. Goldman Sachs also cut its rating on the stock to sell from neutral. There are now 5 buy ratings, 8 holds, and 2 sells on the street, and that stock down nearly 9% this morning. Lastly, we're watching shares of Expedia. Those shares on the up this morning, up more than 16%. That stock moving higher after it posted strong results and pointed to a better than expected outlook for the holiday quarter. That led to 3 firms raising their price target on the stock. Benchmark raised it to $310, Deutsche Bank to $235, and RBC to $260. Now, the average 12-month price target on the street is right about where it is now at $252. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the trading session.
Now time for some of today's trending tickers. We're watching Take-Two, Wendy's, and MP Materials. First up, Take-Two. The video game maker delayed the release of Grand Theft Auto 6 yet again. It's now expected to launch in November of 2026. In a statement that accompanied quarterly results, Take-Two said it's giving the Rockstar team some additional time to finish the game with the high level of polish that players expect and deserve. But analysts aren't too fazed by the delay, and they note it pushes the release into the key holiday shopping season. I wish we could say the same for the people who are awaiting the game, the fans. They are most definitely phased, speaking from anecdotal evidence. Next up, we got Wendy's. Shares rising as its earnings results came in better than feared. Still, the fast casual chain posted lower sales and profit in the third quarter as consumers continue to cut their spending. The results come after Wendy's last month launched its new strategic plan to revitalize the brand, spark growth, and boost profit. The stock earlier traded up as much as 15%, the most intraday before 2021, before being halted for volatility. Short interest, by the way, about 14% of float. That's according to data from S3 Partners. And finally, MP Materials, the largest rare earth miner in the Western Hemisphere, out with third quarter results. The company posted revenue that came in better than Wall Street expected. MP also reported a smaller than expected loss and guided to profits in the fourth quarter. Rare earth stocks have been on a wild ride this year, surging amid U.S.-China trade tensions and ultimately then slumping after the two nations reached a trade accord. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We got much more market action coming up, including a discussion about AI and women in AI. Stay tuned. Well, one recent study shows that only about 1 in 4 professionals in AI are women. Meanwhile, nearly half of AI systems across industries showed gender bias. So why is that significant? How can it be solved? Joining me in the studio, Ramila Nadi, Women Leading AI founder and executive director. Ramila, thank you so much for being here.
Thank you, Julie. Thank you for having me.
Yeah, so this is a new organization that you've just begun. Obviously, we're talking about AI all day long, every day, it feels like sometimes. But what is the angle for you, and why did you see a need to create this kind of an organization?
Absolutely. So a little bit of background on me. I'm a portfolio manager turned founder. Over the last couple of years, all we did in finance was talk about how AI was going to do away with 1 out of every 7 jobs, and how there were going to be investment opportunities. And now there's so much focus on data centers. And I realized, you know what, I do think that this is going to be completely transformative, not just to my space, finance, but across all domains. So last year, I took a complete leap of faith and went full in on AI. And I've been studying and working to understand AI and the models and the algorithms behind it. And as part of that, I founded Women Leading AI. And you know, based on the statistics that you just cited, that's exactly why we're doing this. To me, it became prevalent and just and very striking about the absence of women and multidisciplinary voices. Folks such as myself who haven't worked for big tech, don't have a CS degree, although I've studied statistics, and it's really going to impact our roles, our jobs, and what can we do about this? So that's the whole premise.
And I should say, last night I helped moderate a panel for an event you had, and certainly there was good representation of women who are already working in AI at that event. But you know, what are you hearing from people about how you go about increasing this representation that you're talking about?
Absolutely. Well, first of all, thank you so much for moderating.
Yeah, of course.
The feedback that we have received has been off the charts. Everyone was so excited. They were asking, when is the next event?
Yeah, so what do you do to get that increase in representation?
Exactly. So we believe at Women Leading AI that it's really about education. It starts by raising the public discourse, as we did last night, and it starts by educating people, helping bridge the gap between the folks who are building these systems and the folks who are going to be affected by these systems. So this isn't, the late 90s and Microsoft Word or PowerPoint and using that to make a presentation. AI is going to write presentations, but in order to use that effectively and responsibly, we need to elevate the public awareness around AI.
Do you find that you're getting sort of corporate buy-in to your message? Because it feels like, this would fall potentially into the DEI category. And as we know, there's been sort of a big cultural backlash against that. So from not just women, but from corporations, what are you hearing from them?
So we have been receiving interest, but I completely sympathize with the DEI aspect that you're raising, but I can't hide the fact that I'm a female and that women make up half of the population, and that's nothing too controversial, I hope. So for us, it's really about elevating the discourse and the education and bringing women and other cross-disciplinary folks to the table. And I've already had institutions reach out to me asking about partnering on events and panels that feature women who are driving AI across their various domains.
And so as you think about women in AI and just AI generally, like what are the sort of most critical issues that you think need to be addressed, and obviously with women as part of that conversation?
Well, the first thing is the access. So only 22 to 30% of the global workforce is female when it comes to AI, and that 30% is being very generous. Women are less likely, as you cited earlier, to adopt Gen AI tools. And for us, it's about bringing people together and making those connections between these phenomenal women who are driving AI initiatives within their domains and their institutions, but they don't come from a technical background, as you saw on last night's panel. They're either lawyers or they're running credit research teams or they're professors. So it's about connecting women and other professionals with these women who are driving these changes.
Now, you mentioned earlier 1 in 7 jobs could be eliminated as a result of this. We're already starting to see layoffs, some of them directly related to AI, some of them other business reasons. And so if that's the case, how do you go about preparing a workforce to be sort of AI proof in a way?
That's such a great question, and I spend a lot of time meeting and speaking to students right here in New York City, whether at Cornell or at Columbia, and this is what they're asking me. I have students approaching me and asking, how can I gain a foothold in finance, in the industry? How can I start out? And I think back to when I started, and the landscape is so different. And you're right, jobs may go away, but I think the beautiful thing and the agency that we have is to level up on the education and the awareness and help make that pie grow bigger for everybody. I think the tech sector prides itself on being very disruptive, and it is disruptive, absolutely. Whether on the investment side, you hear about, there's a lot of hype, and you hear about investments into data centers or the next great AI startup, and then there's also a lot of fear. I have friends and colleagues in the industry for several years and decades, and they're concerned about being automated out of a job in 3 to 5 years. So some jobs will be impacted, some will go away, but as with any general purpose technology, which we view AI to be, we believe that with education, we're going to be able to grow that pie bigger and help offset the disruption. That disruption doesn't need to be economic disruption. We can maintain economic stability. It can be disruption in terms of efficiency and new roles that people haven't even thought about.
Here's hoping. Ramila, thank you so much for coming in. Appreciate it. We got much more markets action coming up. Stay tuned. You're watching Market Catalyst. Have you made your list? No, not your holiday gift list. We're talking about a list of strategies to prepare your finances for 2026. Let's go through that to-do list with John Shrewsbury, Gen Wealth Financial Advisors co-owner and managing principal. He joins us for this week's FA Corner, brought to you by Capital Group. Thanks so much for being here, John. So let's go through some of these to-dos. First up, your required minimum distributions. What are they, and what do people need to do about them?
Well, if you hold an IRA and if you're 72 or older, you have a required minimum distribution, meaning that you have to take a certain amount out of that IRA as prescribed by the IRS rules. If you don't do that by the end of the year, if you don't take that minimum distribution, you can take a 25% penalty for not taking the RMD. Now that is just the penalty. You also pay tax on the RMD that was due when you eventually take it out. So it's something that is easily forgotten, especially by elderly folks who have IRAs, and it is a very costly penalty. So that would be number one on our to-do list from a time-sensitive standpoint. And then secondly, I think that there is a situation where most people are taking money from their IRAs. You need to judge whether or not that distribution that you're taking is enough to satisfy the required minimum distribution.
And then let's also talk about tax optimization and what people need to do as they get through the end of the year in order to minimize the amounts of taxes, hopefully, that they're going to be paying.
It's been a great year in the market, and a lot of people have gains that they have potentially even realized in their portfolios. You may have a loser there, and that could help you tax-wise. If you sell that loser, then you're going to offset some of the gain that you might have taken from some of the other holdings that you have. That is essentially called tax loss harvesting. If losses exceed $3,000, the IRS allows additional losses to be carried forward in the next year, but you net those out before you ever get to that calculation. So you could have a loss based on maybe a loser that you have in your portfolio, and maybe some gain could offset some of that loss, but you could then carry forward $3,000 into the next tax year. But all of that has to be looked at and calculated before year end, or the tax loss harvesting becomes ineffective.
Gotcha. So the clock is ticking on that one. So those are the two that are a little more time sensitive. But the approaching end of the year is also a good opportunity to do some sort of, good portfolio hygiene, if you will, right? So if you're looking at your estate documents, what are we talking about are estate documents, and what do people need to do with them sort of on a regular basis?
I think you first of all have to be sure that everything is up to date. Your wills and trust are all in good shape. And a real key area that I see that a lot of people make mistakes in is sometimes there's a change in your family situation. Maybe there's a divorce or something of that nature, and maybe the estate documents are okay, but maybe the beneficiary designations need to be updated. Certainly you want to look at all of these things, and the end of the year is a really good time to slow down and look at that and make sure everything is in line with where you need it to be. I would also say it's a great time to manage risk. There's a lot of risk that we all at various times manage, but it's easy for your property insurance to get out of line unless maybe you've made an addition to your house or something of that nature. The property insurance may not be up to speed and covering everything that you have. Liability insurance, as your net worth grows, your liability insurance needs to increase. And of course, life insurance, if you are responsible for bringing income into the family and that income has gone up over the years, your life insurance may be inadequate to do that. So reviewing that would be a real good thing to do toward the end of the year as well.
And then there's also just generally managing your risk, John. How should you be thinking about that, again, on that sort of regular cadence?
Well, I think that when you look at your portfolio, you have to ask yourself, okay, do I have too much on the table right now in terms of equities? We've had a really good run in the equity market for the last couple of years. You may want to take a look at rebalancing some of that, and rebalance is one of those technical terms that we use in our industry. But essentially, what it is to the folks at home is taking some risk off the table and maybe putting that more into more calm, staid type investments that you'll be able to use in your retirement. Rebalancing is certainly something that you want to continue to do throughout the year, but the year end gives you that opportunity to maybe couple rebalancing with some tax loss harvesting and clean up things that may be a mess going into 2026.
And John, we're almost out of time, but quickly, I did want to ask about changes in the economy and what's just one suggestion that you have for people to address any changes?
I think that you have to continue to be vigilant about what's going on in the economy. There's a lot of concern right now. Consumer sentiment just came out, and it's at a fairly low point of recent past, but the market seems to be doing well. About 83% of the companies that are reporting earnings have been positive or exceeding their expectations. So you have to begin to balance what the sentiment is against the reality.
John, thank you so much. Really appreciate it. And that
was
Great
to be with you, Julie.
Thank you. That was FA Corner, brought to you by Capital Group. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere.